Hi, my name is Luke. I'm making this video as tutorial for basic technical analysis of trading stocks. A widely used indicator in technical analysis that helps smooth out the price action by filtering out the noise from the random price fluctuations. A moving average is a trend following or lagging indicator because it's based on the past price. And this guy is Granville. The photo was taken in 1981. Granville was a financial writer and investment seminar speaker. He's most famous for inventing and developing the concept unbalanced volume (OBV). But today we will talk about his another famous rules, Granville's 8 trading rule. These rules are related to the moving average, and this chart will show you how to get the number for the 5-day moving average. There is a set of numbers from 11 to 17. If you want to get the number for first day of 5-day simple moving average, you need to add up the first 5 numbers and divide it by 5. Because you choose the period 5 days and then you divide it by 5. If you want to choose 10-day simple moving average, and then you need to divide by 10. The first day of 5-day simple moving average, the result is 13. The number for second day of 5-day simple moving average, add up with another 5 numbers, and the first number 12 would be also the second number of this set of numbers. Because you are calculating about the second day of 5-day simple moving average, so you need to start from the second number of this set of numbers and add up another 4 numbers and divide it by 5. You can get the result 14. The third day of 5-day simple moving average, you choose the third numbers of this set of numbers, 13, and add up with the following 4 numbers and divide it by 5. You will get the result 15. Granville's 8 rules including 4 buy signals and 4 sell signals. The first buy signal, if the moving average line flattens out after a significant decline or began to rise. At this moment, the stock price passed up through the moving average. Here, it's considered to be a buy point. The same holds true if the moving average flattens out or rises after the stock has passed through the moving average line. And this one buy signal is a golden cross. Most of stocks in their bullish channel would follow this rule. The rest those are not suitable for the retail investors. The second buy signal is also a good chance. If the stock price is above the moving average, this period, the price of stocks are running above the moving average always. The price of the stock declines near to the moving average, but it fails to go through the moving average. For the following days, it rises up very fast. It's considered to be another buy point. You see, for the following days, the share price turns up again. It's considered to be another buy point. Let's look for the third buy point. The third buy signal. Once the stop price falls below the moving average, and then the moving average is still rising aggressively, this is considered to be a buying opportunity. This point fall below the moving average, but the moving average is still rising aggressively. It's another buy point. It's the third one. If the moving average is declining and the stop price falls under it too fast, it's likely to return the moving average. Here. The stock can be bought to profit from the short-term snapback. The range between the moving average and stock price is huge. You can check with the buyers. It reached 4.8%. This rule does better refer to another indicators like dynamic chip buyers. It might be helpful for you to know that when our company traders are using this technique, they generally prefer to wait for new signs that the downward momentum is abating or that it is actually reversed before the chase. But this is only one buy signal in the downtrend channel. Therefore, buy at this point, which is more dangerous. If you are not professional, do not try to buy at this point. Even the bias is very high also. There are also for sale points when we get some profit from the stock market. If the moving average has been rising and then it flattens out or is declining, flattens out, declining, and the share of the stock go down through the moving average at this point. It's considered to be a sell signal. The same thing holds true if the flattens out of the moving average or its decline occurs after the stock has passed downwards through the moving average. It's the first sell point. And the second buy signal, if while the moving average is following and the share of the stock rises above the moving average, this is also an opportunity to sell at a good price before the stock resumes its decline. the moving average is declining, but the share price ran above the moving average is considered to be another sell signal. And the third one, if the stock price rises toward a moving average from below, but failed to go through the moving average and start to turn down again. The resistance offered by the moving average is too strong for the stock and is a sell signal. And the last one is also the only one we operate in the downward trend. If the stock price moves rapidly above the rising moving average line too fast, it's likely to have a reaction move back toward the moving average. Let's look for the fourth sell point. And the stock can be sold for short-term technical reaction. You also need to check with the bears. It reached minus 4.8%. It's a short-term technical reaction. It's generally best to wait for new sign that the uptrend momentum is abating or that it has actually reversed before the sale. In the real case, how many days of the moving average as one period? The investor Granville using 20 days moving average, but every company has different trading period. We should go through its historical price and then pick one the most compatible period. It is best to use more than a moving average to define buy and sell points. Through investors learn to use a variety of indicators in concert. You better come to watch my next video. My company as the only one can access level 2 data from SGX and use our experience to analyze them. The one simple indicator would easily tell you the best timing to increase the accuracy rate. This indicator combined with Granville's 8 rules, volume, best, time, and those orders from the financial institutions.